Hello everyone, here's a video for what are options for beginners. Now this is very much for beginners. There will be no advanced content. I'm really going to go through the basics. What are options? The lingo, what moves the price? How does it work? Let's jump right in. Number one, there are two types of options. All right. There are call options. This is for buying. This is when you think the stock will go up. There are put options. This is for selling, also known as shorting. Just need to know that for now. Nothing more to it. Now we're going to get into the real details. What is an options contract? So, options. Here's the complicated definition, and then I will break it down much simpler. But options are financial contracts that give the holder the right to buy or sell a financial instrument at a specific price for a certain period of time. Options are available for numerous financial products such as stocks, commodities, and indexes. Like most other asset classes, options can be purchased through an investment broker account. All right? Now, in simple words, what does this mean? Here's what it is. For simplicity's purposes, I'm going to only look at buying, so therefore call options, and we're only going to stick to stocks. I'm not going to talk about commodities and indexes and so on. It's more or less the same, but it's just to keep the lingo and the words simple and not have to explain the switch side of the shorting. So once again, we're looking at call options. So for buying, for stocks. Basically, what are options? Call options give you the right to buy a stock at a predefined price for a certain amount of time. So it's basically a contract that says you're allowed to buy stock A at this price up until this date. Here's an example. Let's say we're looking at stock A. Stock A currently trades at $100 per share. You think it's going to go up. In the next 6 months, you think it's going to go up quite a bit. So what do? You buy an options contract, in this case a call option, that gives you the right to buy this stock at $105. And this contract expires in 6 months. Don't worry, we'll go through the why and how and everything else. So it's trading at $100, but you think it's going to go up. So you buy a contract that says you can buy it at $105 no matter what happens. So this means if this stock goes above $105, you can still buy it at $105 and you can pocket the difference. So if in the next 6 months it goes up to $110, $150, $1,000 per share, you can still buy it at $105. This is the simple version of what are options contract. They give you a certain amount of time to buy a stock at a pre-established price. All right? Now, contracts have three important components. All right? This is learning the lingo, basically. There's the premium, there is the strike price, and there is the expiry date. I'm going to go through all three of them, right? But you need to understand these words. The first one, the simplest one, the premium. The premium is simply a fancy word for the price that you pay for the options contract. It's how much you have to pay for the contract, all right? Now, the premium can vary. Here's the things that will affect the premium. The expiry date, the strike price, the price of the actual stock itself, and volatility in the market. Is the market moving a lot or is the market moving a little? All right. All these things will affect the price that you have to pay, which is known as the premium. Now, component number two, the strike price. All right. The strike price is the fixed price at which the option holder can buy the stock at. So to go back to our example of before, I said the stock was trading at $100, but you were allowed to buy it at $105 for the next 6 months. The $105 is the strike price, all right? That being said, you can buy various strike prices for contracts. So that means in this same example, all right? In our example, the strike price was $105. So that means this is what we call an out of the money option, okay? Meaning that it's trading at 100, it's not yet in the profits. It needs to go above 105 to be in the profits, all right? Now you could buy a strike price of, let's say, $90 for the same stock. Now you might say, well, the stock is already trading at 100. How can I buy a $90 option? Wouldn't that mean I'm already in the profits? Yes. You are already in the profits. This is called an in-the-money option. Now, I know what you're thinking. You're thinking, well, I'm just going to buy that and sell it right away and pocket the difference. Well, the fact is, the strike price will affect how much you pay, so therefore your premium for that options contract. Obviously, if it's already in the money, it will be more expensive to buy that contract than if it's not already in the money. The market's not dumb. It knows what's happening. These things are already priced into the price of the contract that you're going to pay. All right? So hopefully that part's clear. The strike price is quite important. Now, third but not least, the expiry date. The expiry date, once again, will affect the price of a contract. Now, this is quite self-explanatory, right? Every contract has an expiry date. It's good until that date, all right? Now, again, you can choose various expiry dates. You can choose a contract that expires tomorrow. You can choose a contract that expires in over a year from now. You must understand the expiry date affects the price that you will pay, therefore the premium, right? The premium. So, further expiry date, more expensive to buy. Closer expiry date, cheaper to buy. Why? Because you have longer for your trade to come true, right? So that means if you have a year for the stock to move above the strike price that you chose, or if you have 2 days, obviously it would make sense that the 1 year contract giving you 1 year for the trade to come to fruition would be more expensive than the one that only gives you 1 day or 2 days. All right? Now, it's important to understand, we spoke about in the money options, which means already in the profits, and out of the money. So if your contract expires out of the money, so we'll go back to our example A. You bought a contract that says you can buy stock A at $105. It's currently trading at $100, meaning it's not yet in the profits. If it expires and it's still at $100, so it doesn't move above the 105, your contract is worthless. It is worth $0. Now, if a contract comes to term and it's within the money, obviously there's value there, right? Because you can pocket the difference. You can just buy those stocks at the price that you're allowed to buy them at the strike price. So again, to go back, if your contract expires, you're allowed to buy stock A at $90. It's currently trading at $100. Well, you could pocket $10 per share. So that will be reflected in the price of your options contract. Now, why would I buy options rather than buy the stock? All right. This is a question people ask a lot when they don't fully understand how the options work. Well, first of all standard options contracts are for 100 shares of a company. So company A. So for example, we said you could buy company A at $100 or $105, sorry. So you would get 100 shares at $105. So this means that options give you leverage, all right, because they're always for 100 shares. You can therefore buy many more options than you can shares for the same amount of money, right? For $200, you might be able to buy one Apple share, but for $200, you might also be able to buy multiple options contract for Apple. Due to the leverage, options contract prices move by bigger percentage than the actual stock. Now, essentially what this means is if a stock goes up 1%, the value of your options may go up by more than 1%. It may go up by 2, 3, 10, 20, 50%. It depends on the expiry date and the strike price, all right? So again, I don't want to get too technical here. Just know that options give you leverage and that putting $100 in options and $100 on a share, if the share goes up 1%, your options may go up by much more than that. Now, it's important to understand it goes the other way also. If the stock loses 1%, your options may lose much more than 1%. In fact, they will lose much more than 1%. Now, you don't actually need to buy the stocks to make money with options, right? I'm telling you, you have the right to buy stock A at $105. You don't actually need to buy it. You just buy the contract, the stock goes up, therefore the value of your options contract will also go up. So you can just sell it to someone else. So in conclusion, you can get more bang for your buck with options. For example, if a stock moves, as I mentioned, by 1%, your options may move by 3, 4, 5, 10, 20%. This depends on various factors, such as the expiry date and the strike price. All right. So basically, options give you leverage. Now, important notes. This presentation is really an introduction for beginners on what an options contract is. However, there are a lot more components to options contracts, such as something known as the Greeks. The Greeks will essentially tell you how much your option contract will move by, how much will it go up if the stock goes up 1%? How much value will it lose for every day that goes by? So on and so forth. All right. This is more advanced stuff. I'll make another video for that. But for now, let's just focus on the basics. The premium is the price you pay. The strike price, that's the price you're allowed to buy it at. And the expiration date, obviously self-explanatory. So options are also, they're often used to hedge positions. I'm not sure if you guys know what hedging is. Essentially mean to protect your investment from downside risk. So if you buy stocks of Apple, you may want to buy options that say that if Apple goes down, you make money. Why? Because even though in the long run you think Apple will go up, you might think that short term something happened that may cause it to come down. And you may also want to make money on the downside for that short period of time. All right? So again, options often used for hedging. Now, the most you can lose when buying call options or put options is essentially the premium that you pay. All right. Now, it's important to understand that more advanced strategies allow you to write options. So you're the one that actually sells it to others. In these cases, you can lose much more money. Again, those are more advanced strategies. For now, we just want to focus on buying call options or put options. So in those cases, whatever you pay for the options is the most you can lose. Options are bought and sold in what we call an options chain. All right. It's essentially like a grid that shows all the details of all the different contracts. You get to choose which date you want as an expiry date, which strike price do you want, and then you'll see how much people are willing to sell it to you for. So here's a picture of what an options chain looks like. I don't want this to become confusing. It's just to give you guys a glimpse or a quick overview. But in essence, if you take a look at the top left, you'll see the symbol. So this is the Apple options chain. I filtered it so it only shows call options, right? Sometimes on the right side, you will have the put options as well. So essentially here you see calls at the top right underneath the Apple symbol. And then you see the bid and the ask. So if you know about trading, you understand that that's the price you need to pay to either buy or sell your options at the current market price. Then the column all the way to the right is what we were talking about earlier, the strike price. So you can choose various strike prices. And then all the way at the bottom here, we have the expiration date. Once again, you can choose various expiration dates. That being said, it may look slightly differently from one software to another. Nonetheless, this gives you a quick overview of what it may look like and what are all the different options that you can choose from when choosing your options. I hope that all of this was insightful. I hope that it gave you a quick understanding of what options are, what they may be used for, and all the different things that affect the price. I'll make more in-depth videos, more advanced videos also, for people that are more intermediate or advanced in terms of options trading. But I hope this was helpful. If you enjoyed the content, please subscribe to my YouTube channel and give the video a like. Thank you and have a good day.